And these are the criteria that we want to look at when putting this trade on. So we're looking, the underlying is SPX, obviously. We're looking for the duration of about 45 to 50 days to expiration. We're looking for short call delta at or around 30 and a short put delta at or around 30 as well, right? So we're selling a 30 delta call and a 30 delta put. And we're using 10-point wings. So these are 10-point wide credit spreads. So 10 points on the upside and 10 points on the downside. Now we're looking for a credit between 520 and 540. Right? So if we model this trade where we're selling a 30 delta call and a 30 delta put, and for some reason we're seeing a total credit for this trade $580, that tells me that something is off. I mean, it's nice to get a higher credit, but remember, the higher the credit, the more risk we're taking. So maybe the calls need to be moved higher. Maybe the puts need to be moved a little bit higher. Because in this trade setup, most of the profit is going to come from selling a bear call spread. That's where most of the credit comes from. And just as a guide, when we put this trade on, so from 520 or 540 credit, 320 of this credit, or about 60% of this credit, comes from the call side. Now we can talk about our profit target. As mentioned, we're looking to make 20% of this credit. So whatever credit we get, we multiply that by 0.2, and that'll give you your profit target. And whatever that profit target is, in dollar terms, risk in this trade is 1 times whatever that profit target is. So if we're looking to make 1, we don't want to risk more than 1. Now, is there a chance we can lose more than 1? Yes. We don't want to lose 3. So as a guide, we're going to use that number, whatever that profit target number is. Is it 1, 110? That's our max allowable loss point is. And expected days in the trade, we're looking to be in this trade for about 20 to 30 days. Now, there are times, and we've done trades in the past, where we put this trade on, we're taking about a 530 credit, and then 2 days later, this trade is going for about 470 mid-price, right? So 2 days into this trade, we have a profit of about 40 to 50 cents. So we're not quite at our profit target of $1, but 2 days later, this trade is showing a profit of about 40 to 50 cents. Is that a good time to take this trade off early for a profit? If we're looking to make $1 in 20 days, but we could make 40 cents in 2 days, I would consider an early exit out of this trade. So I do get questions often, when we put this trade on and it's showing a profit of, 30, maybe 40 cents in the first couple of days. And I say that, this is a good time to consider early exit. Some people are confused and they don't understand why. So if you want to, look at it in relative terms, if you're looking to make $1 over 20 days, but you can make 40 cents in 2 days, it makes sense to take this trade off. And if your view on the market is still the same, right? If you're thinking that upside may come at a slower rate, then it's okay to take this trade off and maybe put a new trade on where you're getting a 520 or a 540 credit to put a new trade on. So that's something to consider, right? If we're looking to be in this trade for 20 to 30 days and looking to make $1 over that period, if we can make half of our profit target in the first 5 days, that's definitely a good time to consider taking an early exit. And it happens, so it happens a lot. Reason being is, like I said, 60% of this credit will come from the call side. If we just see not what we saw last week. I mean, last week we just saw a big move lower, a big spike in implied volatility, and then a reversal intraday and close well off the lows. That really doesn't count. But if we, sometimes we see after putting this trade on, we see a market go down just a little bit over the first couple of days, and the credit that's received for the bear call spread drops, from 320, it goes to 280, and the puts, they go from about $2 to maybe 210. Right, so we're getting about 40 cents here, and we're losing about 10 cents here. We're still at a net profit. But if that happens in the first 5 days, that's a good exit. If nothing else, obviously this trade is going to make money as long as we see rate of change on the upside slow down. And this is something I want to talk about next. A trade setup like this, it's probably hard to see here, but we are getting implied odds of about 45%. Right, there's a 45% chance that SPX is going to finish somewhere between our short strikes. However, we're not looking to hold this trade until expiration. Right, we're taking in a credit of 520. We're looking to get out with about $1. So our chance of making money in this trade is higher than 45%. And how do we get 45%? So if we're selling a 30 delta call and a 30 delta put, what that means is that there's a 30% chance that SPX is going to end above our short strike, and a 30% chance that it's going to end below our short strike. So if we have 30% chance being outside of our profit area on the downside, and a 30% chance we're going to be outside of the profit area on the upside, there's about a 40% chance that we're going to be somewhere in between. But because we're taking in a $5 credit, that pushes our break-evens on this trade by 5 points away from our short strikes. And if we go look, for example, if we look at right now, 2690 is a 28 delta, and a 2590 is a 27 delta. If we add those two together, that's about 55, which means there's about a 45% probability that SPX is going to be somewhere inside of our short strikes by expiration. So now, if we're going to play this game, right, we have a 50-50 shot here. We take in a $5 credit. Our risk is 5. You can say that this is a zero-sum game, but that's not necessarily true, because implied volatility will often overstate realized volatility, which means that right now, based on current implied volatility, there's a 45% chance that we're going to end between our short strikes. But if implied volatility overstates realized volatility 80% of the time, that increases our chance of success drastically. On top of that, we're not looking to hold this trade to expiration. We're looking to get out of this trade with a small profit of only about 20% of total credit received. So this trade actually has about a close to 85% probability of profit. Now, even if we were playing this game and just blindly relying on probability of profit, which we're not, and I'm going to say this again, I don't recommend anyone just look at probability of profit and blindly put trades on expecting that number to hold, unless you're going to put 1,000 trades minimum, right? That number is not going to really play in your favor. You need a super high number of occurrences in order for this number to help you. But we're not going to put 1,000 IC pluses a year, right? So we have to pick and choose where we enter to this trade. So real quick, I want to talk about implied volatility versus realized volatility. Now, implied volatility is a forward-looking reading that is based on current option pricing data, right? So all of the Greeks, the deltas, the gammas, theta, vega, everything is based off of current implied volatility. That's why I say don't just blindly follow probability of profit, because that number is based off current implied volatility. And if implied volatility goes higher, that number is going to change as well. And realized volatility, or they call it historical volatility also, is a backward-looking reading of actual volatility of daily price changes. And now you can look at also, there is a study in Thinkorswim. So we have this red line is implied volatility. This is what market is implying, looking forward to 30 days. And the green line is the realized volatility. This is looking backwards 20 days, because 20 trading days would be about 30 calendar days, and implied volatility looks at 30 calendar days. So if we compare the two, we always see that implied volatility is actually higher than historical volatility. Now, obviously, there are times where we see a big move in the underlying, and this green line will shoot way above this red line. That's why I say that historical volatility will be underneath implied volatility for the most part, and there's about 15% of the time where actual volatility will be higher than implied volatility. But looking at SPX, where we don't have that kind of event risk, we can see that there's a steady gap between implied and historical volatility, and that is what's known as risk premium. So now going back to our position here, right? So we currently have implied odds of SPX finishing between our short strikes, or between our break-evens, at about 44%. The actual number is higher than that, assuming that implied volatility is currently overstating what's actually going to happen. And we can look at this trade over time, right? We can look at this IC plus 7 days from now. Actually, maybe it's better to look at this, right, with these are 9-day intervals. So if we see a big move to the upside in the underlying today, right, this line here is today. That's not going to be fun. This red line is T plus 9. So 9 days from now, if we see a move higher, it's going to suck, but it's going to suck less. 18 days from now, if we see a move up, it's going to improve and it's going to become a lot better, right? The same move to about 2670, if we saw this today, would be in a drawdown, but 18 days from now, which is about 3 weeks, a move to 2680 would actually put us at break even. And then if we go a little bit further at T plus 27, that same move wouldn't matter as much because this position would be profitable. And then holding this trade for about 36 days, the same move to 2680 would still get to our potential profit target, right? So this goes to the point where I say that when we put this trade on, does it mean that we're necessarily bearish? No, right? We can still see upside, except we need to see more upside at a much slower rate, because as we can see that over time, even if the underlying moves higher, this trade is going to make money. So when we put this trade on, it's okay if we see price continue to trade higher. We just need to see the rate of change to the upside a lot slower. And again, like I said, we're not just going to blindly rely on probability of profit number here, because we're not going to put this trade on 1,000 times a year in order for this number to hold, right? So we can look at something like a the price chart of SPX, right? This is 1 year, and we can go back a little bit further. But what we tend to see, right, in SPX, we see big moves to the upside, and in times of consolidation, maybe we get a pullback, and this is something that we have not seen in 2017. 2017 is right here. We haven't had a 2% pullback. Probably the last time the market moved to the downside and maybe gotten within 2% was maybe this was early August. But since then, we see just nothing but upside here. So because we don't want to blindly rely on probability of profit in this trade, because we're not going to put this trade on 1,000 times a year, we need to be a little choosy about where we're going to put this trade on. So the best time to put this trade on is after a big move to the upside. All right, we see these moves, and then if we entered here, obviously, hindsight trading is a bad game, and I don't want to play that game. But for context, if we enter this trade here, we still may see sideways or slightly higher price action, but slow move to the upside helps this trade. If we are lucky enough to see some sort of pullback, not market crashing, but a pullback, this trade is going to make money. Right? So we want to enter here. We want to enter here. We want to enter here. And we can try to look for some kind of studies or some sort of signals where it'll tell us that the market is overbought. But even right now we could see that RSI is signaling overbought on all three, very short term, medium term, and long term. But as we can see here, right, we were overbought here, and guess what? Overbought could get even more overbought. So that's why we have our profit target and our stop loss. We just don't want to blindly rely on probability of profit. We can try to pick our spots with this trade. We can also look at where we are right now, and just because we put this trade on doesn't mean that this market can't go any higher. But we did see a move from about 2560 to about 2660. So we saw about a 100-point move in the SPX in about 2 to 3 weeks. Does it mean that this market can't go any higher? No. What that means is that if the rate of change, if we're going to move another 100 handles in the next 2 weeks, we're going to get stopped out of this IC plus. But if the rate of change of what we saw over the past 3 weeks is going to change, maybe we go sideways, maybe we go down, maybe we go up, but not as fast as we did in the last 3 weeks, that's going to give this trade an opportunity to make profit. And just touch on the criteria one more time. So if I woke up today and I missed the last 6 months and I said, is today a good time to put this trade on? First thing I want to do is I want to look at a chart, right? I want to understand where we were 2 weeks, 3 weeks ago, where we're likely to go. Obviously we don't know where the market's going, but we can see that if SPX has moved 100 points in the last 3 weeks, 100 points from 2560, we're talking about almost a 4% move in a 3-week time frame. That's, it happens, and there are studies that can tell us about the rate of change, but that's a pretty strong move to the upside. So there's a very good chance, I think, that we have higher odds of SPX trading in some sort of a new range. Maybe we'll see a time-based correction where the market doesn't necessarily correct through price, means the stock or the index will not trade lower, but maybe we'll see a correction through time, which means that instead of piling on another 100 handles in the next 3 weeks, we'll see some sort of a 20-point range in the next 2 to 3 weeks. And that's going to help this trade get to our profit target. So if I woke up today and I said, is today a good time to put this trade on? I look at a chart and it tells me that yes, it looks like we've made quite a move to the upside. I think that I have a good chance of putting this trade on and actually seeing a profit over the next 2 to 3 weeks. This would be my criteria that I want to look at when I consider putting a new trade on. So I choose my underlying, I choose my duration, I choose my strikes for both calls and puts. I look at my net credit for this trade. I set my profit target, and I set my stop loss. Now I can go to the chart and find where my stop loss is on the upside and on the downside. And those are the two levels that I need to worry about, nothing else. Remember, the first thing and always we have to worry about risk. If you take care of that, the profits will take care of themselves.